Hello, in this episode of Are You Ready to Risk Day Trading? We will be discussing about stock holds. As a small cap trader, we always get halted. But what is happening behind the scenes for a stock to get halted? And how can we use the knowledge about stock holds in our everyday day trading? That would be the focus of this episode. So, a stock hold can be defined as a temporary suspension of trading activities. It could be for like a particular stock or it could be for the entire stock market. But whenever a stock is halted, you can no longer buy or sell that stock. And there are four main reasons a stock can get halted. The major one is volatility. That's what we always see. And sometimes the stock can get halted because of pending news or if the SEC or NASDAQ or NYSE thinks there is some concerns with how the company is like reporting the earning or like how the company is like handling their insider trades, the stock can get halted. Or if there is any technical issues in the trading floors of NASDAQ or NYSE, the computer glitches, the stock can get halted due to technical issues. But as a day trader, our major focus would be on three things: volatility, new spending, and regulatory concerns. And whenever a stock gets halted, the exchange like gives out some codes. The T1 hold code is for new spending. Usually the T1 hold codes are initiated by the company. The company will go to SEC and say like, hey, we have some breaking news. And SEC will say, oh, T1. And company can say like, we have a big merger coming up, or like our CEO is stepping down, or we got like $1 billion contract with the government. Then after like 15 minutes, the code becomes T2. That means the company has released this news and it's up to the investors to do their due diligence. And when company issues, not the company, when the exchange issues the T3 code will usually have the news, at least the headlines, and it has two timestamps. The first timestamp will say when the exchange would start taking in calls. That's when the limit orders can be placed. The second timestamp with the T3 code will be when the market would actually open, where you can actively trade this security or stocks. Then T5 is when the exchange thing like the price moved up too much, more than 10% in 5 minutes, and there is absolutely like no catalyst, like there is like no news, like nothing. It's just like going up. T7 is like a very unusual hold. Sometimes there will be like a big buy side or a sell side imbalance. So to rectify that imbalance, the exchange will do like a T7 pause where you cannot trade it, but it will take the codes in and try to like rectify that huge imbalance. T12 is a really bad hold, and you don't really want to be in a stock that is getting hold for T12, because like T12 holds can take up days, like 10 days is the maximum period the stock can be held on T12 codes. H10 is like when the exchange think there is like any manipulation in the stock pricing. Usually happen like in the OTC world and penny stock world. Why it is important to know this code is like when you like research the stocks, if they have a history of T12 or H10, that means the stock is prone to manipulation. Like when you enter these stocks for trading, like you should be really careful and probably put less capital. You can make the whole money in the world, but say like the exchange calls again for like a S10 hold, like you are screwed because your capital will be stuck. You cannot get it off the market, and it could be days before you see that capital again. And if it get delisted, like that's like a capital loss. M1 is usually like done by like mega caps like Apple and Facebook, or like stable micro floats. Stable in the sense that like they don't have the capital, but they are valid companies. Like they have government contracts and they're doing good in their own world. Those most probably like niche companies like dealing with like certain sectors. They don't need that much capital, but they are the only company in that specific sector offering that services, so they are good for themselves. So when those companies like issues like M1, the stocks can go parabolic. That's why like yeah, you have to look for like those M1 codes. And LUDP, volatility trading pause. This would be our favorite. Like whenever our penny stocks or like that, or small caps get halted, like every 1 minute, this LUDP pause. And LUDS is actually like a volatility trading pause for straddle condition. Mm, yeah, I will explain what a straddle is actually, because yeah, it's a lot of them. But in briefly, the market is an auction. The auction is determine the price in NBBO. That's like National Best Bid Offer. So in the NBBO, like there are like two prices, like ask price and the bid price, or the ask or offer or bid price. When you when you want to buy a stock, you can only buy at the ask or offer, and when you sell a stock, you have to sell it at bid. So sometimes what happens is that like the market get really like volatile, and the best bid and best offer will sometimes like fall outside the limit up or limit down set by the volatility trading boss. So when that happens, the market cannot execute their order and it become a straddle condition. Now sometimes the market will call for like T7 and try to get the codes and like rectify the imbalance, or the price falls again between that LUDP volatility bands. Yeah, probably like when yeah, that is like one of the slides which explains the how the LUDP conditions get resolved and what triggers it. Like probably we'll understand when we get there. Yeah, these are this is what I call doomsday hold codes. This is something like as a swing trader I would never want to see. So MWC stands for market wide close, and there is three stages to it. Stage 1, stage 2, stage 3. Stage 1 and 2, that is MWC 1, MWC 2, can only happen before 325. If it's 326, MWC1 and MWC2 circuit breakers wouldn't go. These are actually triggered when SPY drops, like level 1 when SPY drops 7% and level 2 when SPY drops 13%. All these percentages are calculated from the previous day close price. And market wide close stage 3 can happen anytime during the trading hours. When a stage 3 market wide closure is triggered, the whole trading stops. The SPY has dropped like 20%. It can be like 940. No trading is gonna happen. The market is closed for the day, and market will resume the next day. MWC1 and MWC2, the hold is for 15 minutes. And say like MWC3 got triggered and the market is in MWC0. That's like the hold which is carried from the previous day, and SEC like thinks that our president or somebody higher up should come out and clarify what is happening, and thus we have a hope for a better tomorrow. I'm saying like MWC1 triggering during that big COVID drops. And there are actually studies which says that these like circuit breakers are actually making the price drop like event more significant. I don't know, but these were actually like instituted to prevent like a flash sell-off, because a lot of the tradings are done by algos. A lot of traders have like limit orders, so like one big sell-off can like trigger like a lot of sell-offs. So market circuit breakers are there for a function. Yeah, why I put this slide is that because like this is like something I use. From this slide we know the S&P can only drop like 7%. So I'm like a big S&P 500 swing trader. So all my trading loss on SPY is like 4.75 and the next half is at 6%. Why? Because SPY cannot drop more than 7% in 15 minutes. So once I'm in the profit, I put a trailing stop loss for like anything below 7. So say something significant happen and the stock market drops, my SPY is safe and sound in my retirement account. This is like how you apply your knowledge, like some of these things like you really have to think and understand how can you apply this knowledge into the real world. Yeah, I think I had talked about this earlier. Yeah, this is like a web short screenshot from NYSE side. You can see like any given day the stock is getting paused for like LULD, news pending, regulatory concerns. Say like when it's news pending, there is like no time to say, yeah, the time on the right hand side to say when the stock is gonna resume trading. That's why I want you to be like careful. But yeah, like once you're like trading for a while, like you might get interested in these codes, and there are like a lot of strategies that you can build around certain codes. Those are like advanced concept probably. If I'm doing like a second section, like strategy building, I will discuss during that time. Before I go to the next slide, like you have to take care of some housekeeping definition. So there are two types of security. Like when I say security, like stocks, because technical term is security. So the tier 1 securities are like S&P 500, Russell 1000, and every stock that NYSE puts up every year. You just have to Google up NYSE exchange traded products, limit up, limit down protocol. It will bring up a PDF. You can look all those stocks, all those ETFs actually. Those are like tier 1 securities. Then tier 2 is everything else. All of the stocks which is actually traded like in NYSE and NASDAQ. And it's called NMS stocks because like the NMS stock has to report all the transaction buy sell with 90 seconds of that happening. OTC doesn't have that criteria, so they can report it at the end of the day, like whenever they feel like it's less regulated. So not talking about those stocks, but different OTC market has different criteria. But I think like most of us only like trade like NYSE and NASDAQ, so tier 2 is all like NMS stocks. It's usually all the stock list other than the SPY, Russell 100 and those ETFs in tier 1. Okay, LU limit up down protocol circuit breaker is one trading pause or hold we as a day trader usually encounters. Because if you're trading like a small cap or a micro float stock, you're always gonna say, oh, stock is halted. Usually that means the stock triggered LU TP. But sometimes you can see these stocks like flying like 200, 300, 400, and it's now getting halted. And sometimes it end up like 20 cents and geez, it's halted. Like why? Because those trading processes are like executed based on a definition from Nasdaq. So like I said, so if it's a tier 1 security like an ETF, SPY or Russell 1000, if it opens more than $3 from 9:30 a.m. to 3:35 a.m., it can only trade 5% from the previous day closing price. That is the rule. Now you might wonder like, oh, what happens if the stock goes like 100% pre-market? The first 5 minutes price is averaged and the band is like calculated, but you will understand more like when I go to the next slide. But here is like some of the interesting things like I wanna point, because like I said, this is not just about knowing something, it's more about applying the knowledge. Like if you've been day trading for a while, like you would have seen SPY, a lot of ETFs going crazy at market close. The reason that it goes crazy in the market close is because the volatility band which triggered that LU DP or the volatility trading pause is at 10%. So the market makers got a bigger room to move the stock up or down without triggering a volatility trading pause. That's why you see like big movements in the ETFs during that hours. Like my favorite time to trade SPY is usually used in between like 3:35 and 4 p.m. Like if there is like a big movement like more than like 0.15, I am in the trade. Like yeah, once you have enough capital, like like those little moves adds up, and this is something like you can do without risking capital, and in tier 1 and tier 2, which is at $3, get a 40%, 335 to 4p. Crazy. Like, and if you just look up, you can make up your own strategies for like swing trades from like 335 to 355. Yeah, you just have to find the right stocks. It's easy. If you notice it, your trading view stock scanners to find it. 40% more up or down without it hitting any like volatile trading pros is a dream come true for me. Okay. But these advanced strategies, this is right now it's just for like knowledge based, like just do it in a stimulator or something, because a lot of people are gonna lose money if they do it. Most of our stocks are actually cost more than $3. Its volatility band is like 10, and something that closed between 0.5 to 30. The market is at 20%, and this is like a big thing. Sometimes, like when we open a stock, like we see, oh, $2. It goes way higher up without triggering any pauses because it has a 20% band open compared to like a stock that was closed at $3.01. So when I pick my stocks, like if something is trading close to 2.75, like I I like to trade those because my band is open. But remember, the band can get constructed because like all these bands are, when the market opens, most of these bands are defined by the previous days. Then the volatility band get reset around like 9:35. Then it start like using the average price for the last 5 minutes. We show in examples like probably when I say that, like most people can understand it. So let's say like there was like a good ETF. ETFs are Darwin, and the previous day close for the ETF was $20. So when the market opened, the circuit breaker sets a band 5%. So 5% of $20 from the previous is $1. So now this ETF can only trade between like $21 and $19. So say like a huge whale or a bank decided to buy the whole stock at $21. The market doesn't get halted at. It will sit there for 15 seconds. And this is when we say the security or stock entered a limit state. And what happened is that like once the price entered the limit state, the volatility band wouldn't be recalculated, so that like I said, like that price is getting recalculated based on the average price of last 5 minutes. It's not gonna get collected, it's gonna stay there. So two things can happen now. The stock can exit the limit state, or stock can go into the hold state. So for the limit to break, if the market is like really volatile and there are like a lot of buyers, every single order get executed. So so if say the limit up was triggered, that means like $21, the price is trading at 21 and somebody wants to put like a limit order to buy all the stocks at 21. If his order get filled at 21, that is before 15 seconds, the limit state is exited and the stock wouldn't go on hold. The same with like 19. The 19 is the lower band, so that's the bid side. Say somebody wants to sell everything at $19. Stays there for 15 seconds. If somebody was able to sell the entire order on the $19, the market exits the limit state and the price will go down, step down, because selling pressure going down, and the price begins to get recalculated based on the last 5 minutes average price. Why I tell this is that there is like a strategy where called fake halts. Sometimes the market maker can put like a big order on the upper band. So in this case, like somebody decided to put a 10,000 buy order for a stock with a volume of 5,000. What's gonna happen? Volume is 5,000 and he's trying to like do the double. It's gonna stay there for 15 seconds and it's gonna trigger a halt. Sometimes the day traders like are scared and was like, oh, I don't want to go into halt and would start selling. And the market maker will time 15 seconds from the like it's kind of hard to do with like yourself with your brain, but computers can find it and they will cancel that limit order right at 13th or 14th second. So what happened? Now the order is no more there, so the limit state breaks, the price, the stock doesn't get halted. So it's called shaking off. Now everybody like sold to this like big market person for a lower price. That's why we say when the stock gets halted on the upper band, usually if it's like during the early periods of the trading, like 9:45 something, the stock is gonna gap up. Not all stocks, but that's another reason. Like you have to be in the market. Like you need to know which stock this work for. So what stock price this work for? A lot of things. These are the things like I will discuss like in a strategy section, but for right now, those are this is the reason like why you see like a big gap up when the stock is halted or going to halt at the limit price because somebody is accumulating and they're pushing the price up. Like those are things like can I do, but like people with like good capital, like 50K, can like decide where the market is gonna go. At least for the small caps and micro floats. I know it's kind of tough to understand, but when it triggers, it triggers. That's it. Like like so basically, this is what you have to think. Like a quick recap. You have to look in the previous slide and see where my stock belongs to. Then establish like a price band. Then you're gonna calculate the price band based on the previous day, and that will give you a range. It's called upper band or limit up. Lower band is called like limit down. And you put those price, and the price can trade only between those things. But once the market opens and goes past like 35, the circuit breaker volatility band is calculated based on the average price of the last 5 minutes of trading. And only time they stop collecting that average of last 5 minutes of trade is when the market gets into something called limit state. The limit state happens when the stock market market price is sitting at an upper band or a lower band. That means like a market maker has put a big order which cannot be fulfilled with the current volume. It could be buy or a sell. If the order is big enough, it will go into a halt. And one of the techniques the market makers use is they remove their order before 15 seconds and the price will just like go up. Like it's called like shaking. One of the techniques of shaking. I don't know if somebody wants like more explanation, just drop in the comment. Like maybe I can do like a slide to explain this much better, but that's the basic of it. Like I said, just to recap, the volatility bands are not calculated in real time, and they are when the market open is based on the previous close, and once the market opens, the last 5 minutes is used to calculate the volatility band, and the volatility band usually get updated every 30 seconds from 9:35. And this is automatically calculated by like a NASDAQ computer. I think it's called like M2 computer or M21. Like I forgot, it was like a long time ago, but it's like a supercomputer like doing that little calculation. Like, and some some of the traders like wouldn't like show those things, but yeah, probably like once I set up like trading views, I have like a few scripts which like shows up the limit up and limit down. I'll put it in, but that's for one of those videos coming up. Yeah, this is how I'm going to conclude. The halts are like an opportunity, and there are like a lot of trading strategies around it. Like if you got the skill, the knowledge base, the time and money to risk, it could bring like huge rewards. But like I said, it's like betting. Like you need to know like what's happening in the market. Yeah, let me know like if you have any questions in the comments. Like I will try to answer it. Thanks. Like, subscribe, and follow. It's a small channel. Like trying to make some money on the side. That's all, and hopefully I can help you out in this process.